Okay. Good morning and welcome to the webcast. This is our fourth session for the virtual 2020 Building Opportunity Conference from Moss Adams, providing insight into current challenges facing companies operating in the built world. Over the span of this conference, we are looking at topics such as how COVID-19 is shaping the landscape of cities and infrastructure, economic impacts of newly passed bills, business planning in an election year, and post-election tax planning and considerations. More information for each session, including registration, are available in the links provided in your resources widget here on On24, as well as on mossadams.com. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement, or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Thank you. And now let's get to our session this morning, Post-Election Economic Considerations. I'm pleased to introduce both our host today, Elaine Irvin, Partner and National Practice Leader for Construction here at Moss Adams, as well as our special guest presenter, Steve Scranton, Chief Investment Officer and Economist at Washington Trust Bank. Let's turn things over to Elaine to get us started. Elaine, the floor is yours.
Thank you so much. Welcome. We're so pleased to have you join us today in our session. When we first decided to do this session and decided that it was important to look at the economic considerations post-election, we were well aware that, it may be post-election, but maybe not post-decision, knowing what the decision and the resolution of all the races are. And in fact, that's where we're at. But I'm always thrilled to have Steve Scranton join us. He spoke at our Building Opportunity Conferences for a number of years, and I really believe that he brings some valuable insights as to what we're facing on the economy and a look into the future. So with that, I'm going to turn it over to you, Steve.
Thank you very much, Elaine, and good morning, everybody. Just wanted to first, touch base quickly, as Elaine said, that even though the elections are over, the results aren't over yet. I think we all need to realize that this election season had a lot of drama and probably created a lot of trauma, since there were deeply embedded emotions on either side So when we get the final results, some people are going to be elated, other people are going to be very upset and potentially angry. I'm going to simply tell you, I'm not a political analyst. I'm not here to confirm your emotions or to challenge your emotions. I'm here purely to give you my perspective and information about how we should be thinking about the economy moving forward. The only thing I'd really give you from a couple quick bullet points I'd give you regarding the political process. First thing I would tell you is that we all need to remember politics don't drive the economy. It's consumer and business spending that drives the economy. Now, policy may influence that, but politics itself makes for great 24 media headlines, but it really does not drive the economy. And I just think we need to always keep that in mind so we don't get sucked into the trap of being glued to the TV rather than focusing on our business and what we need to do. The only piece of information I can give you right now that I'd say we need to pay attention to, there was a lot of media coverage yesterday saying that the blue wave or the Democratic sweep failed and that the Republicans were retaining control of the Senate. There is still a possibility of the Democrats taking over the Senate. It all comes down to Georgia. Georgia's laws are such that if you win, you have to win by at least 50%. And if you don't, then there has to be a runoff election. One of their senators is already in a runoff because he did not achieve 50%. The other one currently is just above 50%, waiting to see the final results from Georgia. But we may well see a case of 2 Senate seats up for a runoff election, which would be, I think, January 5th is when they do that. So there is still a slim possibility that if for some reason both of those swung to Democrats, even though the Republicans won the current round but didn't get 50%, that is the only path that the Democrats would have towards taking over the Senate. What we see is that from an economic standpoint, if the Republicans do hold on to the Senate, I think that creates a lot of relief and maybe a little more clarity for businesses especially, because with a split Congress, what you would have then is the chances for the tax increases that were part of candidate Biden's platform probably don't get passed, or if there's some form of increased taxes, it probably wouldn't be happening in 2021 as they focus on other issues there. The new Green Deal that the progressive side of the Democrats are pushing wouldn't be happening. I think that the risk, and we've seen this in the stock market with the tech companies, the risk for more restrictive legislation against the tech companies and more aggressive antitrust pursuit is probably going to be diminished there. And the other thing, which has created a lot of relief from the bond market, is that the reality is with a split Congress, we would probably have a new fiscal aid package somewhere in the $1.5 to $2 trillion range, rather than the number that was being thrown around with the Democratic sweep that it could be as high as $5 trillion. The concern from the bond market, of course, is the bigger the aid package, the more debt has to be issued and the more bonds they have to absorb there. So that's really the perspective. The only other perspective I'd give you from the from the political standpoint is that we do have to understand, if we end up with a split Congress, that since World War II, 62% of the time we have had a split Congress. So this is nothing unique that we have to try and figure out what that means. I think that what it means is more than anything else is that there's going to need to be more cooperation, and there's probably more moderation, that the extreme policies on either side have far less chance of getting passed. So where my focus is, if looking forward as we're trying to look down the road for recovery, is, what should we be thinking about here? And for many of those who've heard me speak before, you always know that my mantra is, it all starts with jobs, because jobs are what create the income for the consumer, and that allows them to spend. And consumer spending still makes up, even in this recession, makes up almost 70% of economic growth. So what I want to do first is actually, to keep this interactive, what I'm going to do throughout my session is I've got 4 polling questions, and I'm going to pause during those time periods, except for the first one. I'm going to pause to take questions throughout my presentation rather than making you wait till the very end. But if we could have the first polling question brought up, since we're talking about jobs, I really wanted to get your perspective to let me know, because I always love to get real life feedback from the industry itself. How would you describe the current job market for your industry in your geographic region? Is there no recovery from the lockdown impact of jobs being lost? Is it slowly recovering the jobs that got lost? Is it back to the conditions that existed at the end of February? So essentially fully recovering your job losses? Or is it booming that you're just, having so much demand, you're seeing heavy job creation as a result? So if we want to take a minute to answer those questions, what I would tell you in between while you have a chance to answer those questions, my perspective regarding this recovery is that this is really a tale of two recoveries. It truly matters where you live, what type of job you have, as to whether you think that we're recovering, we're still in recession, or maybe you even think we're in a depression there. And I'm going to give you information to show you what I'm talking about there. But the first thing that we start from that standpoint is the jobs picture to see just exactly where do we stand with jobs. I'm going to give you that perspective as a percent of where we stood in February. So how much have we recovered jobs? So let's first pause for just a second. I think our time is up. And we can see here that the majority, or close to the majority, almost 50% of you say that jobs are slowly recovering. The next biggest is that you're back to where you were before the lockdowns occurred. And then the next one after that, which is an encouraging sign, you're saying, no, actually it's booming because of what's going on. I would clearly say, at least for the construction side of the world, that if we haven't fully recovered jobs, it may actually be a case that I've heard from so many of you over the last several years of finding enough qualified help for the demand that you have there. But let me give you my perspective on this. Again, measuring as to how far are we along compared to where we were in February, and to highlight my point about this tale of two recoveries. What we see when we look at the jobs recovery is goods producing side of the economy has fared far better than the service side of the economy. Because when the decision was made by the governors to shut down the non-essential businesses, that was a direct hit into the service sector, especially with the leisure and hospitality area. The goods producing side, manufacturing and construction, I know the state of Washington originally said construction was non-essential, but then opened that up. We have seen, to give you the perspective, for the U.S., we're 95% of the way to recovering our goods producing jobs. For the service side, the U.S. is at 92%. And to be more specific, the construction side within the goods producing side is also at 95% of jobs recovery, compared to when we look at the services side, we see good progress for professional and business services like the accounting field, the law field, that area of professional business services. For the U.S., that's at 94% recovered. But when we look at leisure and hospitality, what do we see? 77%. So it shows you the road that they have to go. I would say that if you're working in construction, you may be saying, hey, this recovery, this recession is basically over or almost over. And if you're working in hotels or restaurants or any of the leisure and hospitality sector, you may be saying, well, what are you talking about? This is actually a depression. We've never seen it this bad before. Give you the similar perspective for at least the three states that we work in. I recognize there may be other people who joined the call that are in other areas, but when I look at Washington, Oregon, and Idaho, this is the case again of what I'm highlighting, that it matters where you live, because each state, since we didn't have a unified process for dealing with the virus, each state set their own policies for what phase of lockdown you're in. So let me give you some examples, same categories for Washington, Oregon, and Idaho. Washington, the goods producing side is at 96% recovered, which is a little better than the U.S. And the construction side is essentially, with rounding, it's 100% because it's at 99.8% recovered. So clearly there, construction industry in Washington is doing very well. When we look at the service side, Washington, once again, is better than the U.S. We're at 95% recovered for the service side. Professional and business services, things are going great. If you're working in that industry, they're at the professional business services sector of the economy, 101.6% recovery from February's level. So we're actually adding jobs there, not just recovering jobs. And yet we still have leisure and hospitality a little better than the U.S. at 79%, but still the one suffering the biggest damage. Oregon hasn't done as well. Oregon is pretty much like the U.S. They are at 93% for the goods producing side of the economy. Their construction side is at 94.5%, but that is better than their service side. When you look at the service side, they're at 92% jobs recovered. The professional and business service sector is at 93.7%, and then the leisure and hospitality is at 74.1%. So Oregon has definitely been hit harder that way, or at least slower in recovering. Then we flip over to Idaho. Idaho, compared to Washington and Oregon still essentially in phase 2 of the lockdown. Idaho, up until the beginning of October, and this data for jobs is through September 30th, Idaho was in phase 4, and we're in the last legs of phase 4. Now they've had to roll back to phase 3 as the virus has regrown in the Idaho sector. But let me give you the perspective. Idaho, the goods producing sector, 99% recovered for their jobs. The construction sector, 100.4% recovered. Even the service sector has recovered 98% of their jobs lost. We look at the professional business services, 96.6%, but the real difference of where this is truly a tale of two recoveries, when you look at leisure and hospitality for a state like Idaho that is essentially almost fully reopened, or was as of September 30th, 94.7% jobs recovery for leisure and hospitality. So very clearly, like I said, it matters where you live, because if you're in Idaho, different than if you're in Washington or Oregon, and if you work in construction, far different than if you work in leisure and hospitality. So I think that's a perspective we have to keep in mind, that this is not a homogeneous recovery, because it wasn't a homogeneous recession. It hit one area, almost a direct hit to that area. Other areas weren't affected nearly as much, and especially for the goods producing side, because people still were buying stuff that you needed to be able to produce those goods. People still need somewhere to live. That type of process is why we're seeing the goods producing side doing as well as it's doing. If I look then from the jobs perspective and say, where do we stand from the income perspective? All I've got for you on this is national data. The states don't report their income levels anywhere on a timely basis, and even the national side is only through August 31st. But it's a very interesting picture, and it's a very misleading picture when you look at it. Because when you look at the headline number, personal income up 3.6%. You're like, wow, with all the job loss? Because here's the reality we have to keep in perspective when we talk about jobs. There's always what I would say, a undercalculation of what the true unemployment level is for the U.S. We say that we have a 7.9% unemployment rate, but here's the reality in real life. There are still 21.6 million people that are receiving unemployment benefits. The difference is the number that's reported through the media is strictly the traditional unemployment claims, which are through the state's unemployment programs, and that number is below 8 million. The reason for this big difference is when the CARES Act was passed, we swept in a lot of people who traditionally, even if they're unemployed, don't qualify for unemployment benefits. So that's your people like the gig economy who drive Uber or something like that. It's your freelance workers, it's your part-time workers, it's your independent contractors, and it's your sole proprietors. They've all been now included to receive unemployment benefits. And to me, I keep saying, here's our true picture of the economy. This tells us how much the traditional measure of unemployment is missing people because they don't work for a traditional big company that reports through the Bureau of Labor Statistics. So that's the perspective that I would give you. If you actually roll in based off of those people receiving unemployment benefits, the unemployment rate is actually more like 14%, 14.5%. So I just simply say, when we've got that many people still receiving unemployment benefits, that tells us we've got a ways to go on this recovery. And that's why it may be surprising to people to say, well, how's personal income up 3.6%? And what I'm going to tell you there, if you look at the true source of most people's income, their wages, it's actually down 2.9% from where it was at the end of February. The reason why overall personal income is up 3.6% from the end of February is because of the CARES Act and the benefits we provided to people. We essentially replaced the lost income for most of the unemployed, because what we see is that government transfer payments, unemployment insurance, those types of transfer payments are up 29.5% from February. So if we didn't have the CARES Act, we didn't have those extra benefits where they were first receiving $600 additional per week, then it's dropped down to $300 per week. What I would tell you is by the time we get to the end of the year, those benefits go away because they've been used up. And if Congress doesn't pass a new fiscal aid bill, we're going to see a far different story on the income side. One of the things I will say, though, is to give the population credit of understanding the difference between long-term income versus temporary income. Most people have recognized that's going to go away, so I can't be spending all of it because I'm going to need something to make my rent and mortgage payments and pay my bills when I don't get these extra benefits anymore. So what I look at, I'm trying to give you a little more real time. There is a project going on now with Harvard University in cooperation with some major firms like Microsoft, as well as other universities, where they're doing real-time data gathering on consumer spending, tracking credit card, debit cards, things like that. So what I would tell you is here's the picture on the spending side, which is through October 25th. So we're a lot closer to real time right now. Where do we stand? And what we saw is this tale of two economies again. Even though spending as a whole for the U.S. is down, it matters as to where the consumer is spending. What we see for the U.S. is that spending is down 3.9%. For Washington, it's actually up 1%, so essentially flat. Oregon is down 2.3%. And Idaho, once again, because they had far more of their economy open, was up 6.4%. So that difference, again, between matters where you live, but it also matters of what your job is, again, because what we see is the interesting phenomena that people are spending money on groceries and on online retail stuff, and they're not spending money on their health care, on transportation, on hotels and restaurants, or on entertainment and recreation. And just to show you that difference as to what industry you're in as a small business, groceries for the U.S. up 10.4%. Groceries for the state of Washington up 18.3% since the end of December. Oregon is up 24.1%. Apparently they need a lot more groceries, or they like a lot more groceries. And Idaho is up 16.2%. Same story when you look at the retail side. We see that retail, which is primarily the online retail again, up 9.5% for the U.S. It's up 18.7% for the state of Washington. It's up 3.3% for Oregon and 19.6% for Idaho. So if you work for the grocery store, you're working full-time, and they're actually trying to hire more people because now they need people to go in the store to do the shopping for you because you don't want to go to the grocery store. They need somebody to meet you when you come to pick up your groceries and load your groceries, or they need somebody to actually deliver your groceries if you've chosen that option. Same for the retail side. There's the demand there, that why we see Amazon adding more distribution centers. They need people to process those orders. But if you live on the other side, and I'll just go to the two worst, if you look at hotels and restaurants, for the U.S., spending in those areas down 29.1%. For Washington, down 40.2%. Oregon is down 37%. Idaho is only down 14.4% because their restaurants are open more than the Washington and Oregon. It's even worse if you're in the entertainment and recreation, since a lot of our entertainment venues are still just basically shut down or barely open. For the U.S., if you work as a small business in the entertainment and recreation area, you've seen that spending is down 54.4%. If you see it for Washington, it's down 48.2%. Oregon is 50.4%, and then there's Idaho once again, down 4.3%. So the picture that I'm trying to give you with this situation, with jobs, with the income, with spending, it's truly this tale of two recoveries, where it truly does matter where you live and what kind of job you have. Because I would say, once again, people in the goods producing side of the economy would probably say, we're almost done with this recession. People on the service side, other than leisure and hospitality, would say, no, we're still in the recession, but at least it's progressing. And people in leisure and hospitality are probably saying, no, this is more of a depression than a recession. So I think that's the first picture I want to give you. And I want to pause here. Let's take our second poll, because I'm going to lead into my outlook for the economy. So first, I want your outlook for the economy so that we get real life information again, and then take questions as well. So please feel free throughout my presentation, put your questions into the Q&A. I'll be monitoring that and taking breaks as we go along here, so that I'd more than happily answer your questions as we go. Of course, if you've been trained from your school days that you have to wait to the end and then ask questions at the end, I'll be happy to take those questions at the end as well. So I don't see any questions coming through yet, but I will continue to look at that. We'll give it just a few more seconds to go through with what you think is the story for the economy. Question once again is, how long do you think it'll take for the economy to get back to year-end 2019 levels before the recession hit? And so do you think it'll take less than 6 months, 6 to 12 months, or more than 12 months? I think it really, perception it matters there, and it could also be flavored by the fact of what industry you're in. Again, some people may think that it's going to be a very quick recovery. Other people may think, no, this is going to take a while. So what we see is that 2/3 of you think that it's going to take more than 12 months. 29 or 30% of you think it'll take 6 to 12 months, and 4% of you think that it'll take 6 months or less. So great perspective to give there. This is my outlook that I tell you as I look at the economy. I think first we need to understand the damage that was done from the lockdown situation. When we had the country essentially being shut down for non-essential businesses, we saw a 5% annualized decline in the first quarter. We then saw a 31.4% decline in the second quarter. We got this rebound in the third quarter as we started to open up the economy to some degree. So the third quarter gross domestic product rose to 33.1%. But my perspective for you is that you always have to remember on your math thing. I don't know how many of you remember from your math classes when they talked about, something drops 50%, it has to rise 100% to get back to its original starting point. Well, this is very similar here, that even though we rebounded by 33%, we still have to have a further growth of almost 55% to get us back from that, from our original down point, not from the 33%, but we still have a ways to go. The simplest perspective that I would give you is that we're still 3.5% lower than where we were at the end of 2019. And to give you that perspective, because you think, oh, that's no big number. The worst during the great financial crisis of 2007 to 2009, the worst decline like that was 4%. So when it's 3.5%, that's actually a big number. That's saying we still have plenty of work to do to recover there. And I think that I've given my own thoughts as saying that maybe the way we need to think about this economic cycle is that we actually had a depression for the first half of the year. And then Congress stepped in with their aid. Federal Reserve stepped in with all their stimulus. That stopped the depression. And now with the rebound that we've seen, we've come into what would be considered by historical terms, a normal, if there is such a thing, recession now, because we're 3.5% away. I will tell you that for the great financial crisis, it took 2 years to recover from when the recession ended until we got back to the levels of where we were in the end of 2007. So if we're thinking, depending on when they declare the recession ended, I'm going to give you my feedback that I think it's going to be more than 12 months before we get fully back to the levels. And it could be as long as 2 years again, depending on what Congress does to help stimulate the economy and how businesses survive through the process that's going on right now. What I would tell you is there's lots of discussion as to, what's the letter of the alphabet that describes the economy? And some people are still saying it's going to be a V-shaped recovery. I say, I don't see any way that happens because we still have 21 million people. We got the easy part of the rebound done. We haven't lifted the restrictions yet, so we're not fully open. I think that maybe if I'm going to use a letter of the alphabet, which I'm not really a fan of, but the one that could be the most accurate description is what they're now calling a K-shaped recovery. The left-hand side was that just instant plummet when the economy was shut down. If you're in the goods producing side, you're on that rising part of the K. But if you're in the service producing side, especially in leisure and hospitality, you're on that lower leg of the K where you're still not seeing great improvement. I'd rather give you my description. I think that if I'm going to try and describe the recovery, I would call it a square root shaped recovery. You get the initial bounce and then it levels off. That's exactly what we saw after the financial crisis. We got the initial bounce, and then for 10 years, we basically grew at 2 to 3%. So it was positive growth, but it never sped up and it never really sped down. It just was kind of that straight line that goes along with the square root, if you remember your algebra equations. I think this is going to be a similar situation because we still have the challenge. We still don't know truly the damage that we've caused to small business because we're not fully open yet. So I do think we'll get that rebound. I think we level off. And what I'm going to tell you from maybe a cautious standpoint, not here to depress you, just trying to be realistic, I think that growth for this recovery after we get the bounce could be more in the 1 to 2% range because of all the debt that the government has to issue for the programs that they've rolled out and for all the debt that corporate America has taken on. Because even with record low interest rates, the more debt you take on, the more interest expense you have. When you have interest expense, your cash or your revenue, either from taxes for the U.S. or from our business just from their doing business, that revenue, more of it has to be diverted to make those interest payments rather than use it for productive purposes. So I think that, in my mind, is realistically what we could be looking at. I would advise essentially if you plan for and can be successful with 1 to 2% type of economic growth, then you'll be thrilled if it's actually 2 to 3%. But that's what I would tell you right now is that I think you should plan for that. I think you should also plan that interest rates are going to be lower for longer because the Federal Reserve has been very clear that they are going to hold short-term interest rates low at least through 2023. I would tell you from a historical perspective, that's the first time the Fed's ever given an actual timeline of saying, by 2023. During the financial crisis, after the recovery started, they kept saying that, they will provide support and keep rates low enough until the economy gains enough strength to raise rates. And they kept essentially implying, hey, we could raise rates anytime if the economy starts to pick up. The reality is it was 7 years before they actually raised rates. We've had this recession, which is not your historic recession, with this dramatic drop and now this slow recovery. I think, once again, we could see the Federal Reserve holding short-term rates lower clearly through 2023, maybe even longer. And it's really the question then, well, what about long-term interest rates? I think, once again, you could see volatility in long-term rates. But I think, again, until we see more full job recovery and some wage growth, I can't make a case to you to say that we're going to have major inflation. You'll have pockets of inflation, especially as we're starting to see people hoarding again at grocery stores. You'll have pockets of inflation. But again, a one-time increase in prices and then holding steady is not the inflation the Fed worries about. They worry about continually rising inflation. So they have essentially changed their policy now. Previously, their policy was, as we see inflation approaching that 2% level, we'll start to raise rates to keep it from getting above 2%. Now they've said we're going to use an averaging process, that we want it to average around 2%. And since we've had inflation below 2% for an extended period of time, we're willing to tolerate inflation above 2% until we get that average over a longer term basis to 2%. The problem is they don't give you a time frame of what they consider a long-term basis. But I just simply say that when they're going to let inflation run hot for a while, that means it's even longer before they raise rates. So I think that from a borrower, that sounds great. From a saver and investor, that's absolutely horrible because you've lost any income producing abilities that way. So I just think that you should plan for that, whichever way you lean. If you've got excess cash and you're figuring, what am I supposed to do with this? The message from the Federal Reserve is you're not going to get anything on safe investments like bank money market accounts or money market mutual funds or treasury type of securities. You're going to earn essentially nothing, maybe 0.1% or something lower than that. You really can't afford to put that excess cash in the stock market because that's money you need available when you need it and not suffer losses in principal. So the Federal Reserve is essentially saying, whether that's right or wrong, they're essentially saying, take that excess cash and invest it in your business because that's the only place you're going to get a decent return. And I just think that when you've got a very uncertain economic environment, it's pretty hard to convince some business to say, yeah, I'm going to suddenly start reinvesting in plant and equipment on the hope and prayer that the economy is going to recover fully and I'll be in a great position for that. But that is essentially the message coming from the Federal Reserve. So what I also think that we need to look at there is that, and let's go to the poll number 3, if you could, please. What I'd like to know here is how are you finding your new work environment as it relates to productivity compared to pre-pandemic? Are you saying that all my work environment basically did not change? That's what's happened for me. I've been working in the office 100% because I need to be able to, use our internet for these type of presentations, but we also have different systems that I have to make sure are still running. You could say you love it and you hope it stays this way permanently, however your work environment is. You can say that this sucks and you can't wait till we get back to your previous work environment because you really don't like this current environment. Or you can say, hey, it was challenging at first, but I've adapted now and I'm remaining as productive as before. But I think we need to be thinking about this because this affects the situation with workforce migration. If companies truly are letting their employees work permanently from home, things like that, that's going to change the landscape of where work is going to be occurring. And I'll be talking about that shortly. But let me just check once again. I still don't see any questions coming through yet. Oh, wait a second.
Actually, no, there's quite a few.
I apologize. I missed it in trying to read it. So let me back up here because I didn't get the little notification. But bear with me just a second so I can get to the top. So I've got one I wanted to know. Let me go from the bottom up. I think that's probably the easiest. And Elaine, if you see that I'm missing any, please feel free and call it out so that I can try and cover all of them. The first one that I'm seeing is I'm still concerned about the looming defaults on mortgages, past due rents. Is this a valid concern or is the economy somehow braced for this already? I think it's a true concern. That's my case again of back to saying Congress still needs to pass another fiscal aid package. The government is the one who caused this recession. The government is the one who caused the damage. Even though I'm not a fan of taking on more debt, when we still have the situation that we've got with almost 22 million out of work, I think there has to be another aid package to continue to bridge that income loss until those jobs are recovered. So I do think that what I worry about, especially for property owners and things like that, is that the states are going to continue to extend the moratorium on evictions or foreclosures. But that's a problem that's just being kicked down the road. It's got to be addressed. And I think it's a valid concern that many firms, I think, are going to be worrying a lot about that. I know the financial industry, banks, thrifts, credit unions, mortgage originators, especially mortgage servicers, that is a very huge concern of saying it's so uncertain where we stand now. But I think that is very clearly we have to pay attention to that because that has the potential to become a very big problem. Do I think that the economic impacts of the pandemic would have been lessened by a coordinated national response rather than by a state-by-state approach? I would argue from an economic standpoint, I think absolutely a coordinated response would have been a more effective way because then you don't have the situations like we have in Eastern Washington, especially like Spokane. You don't like the phase 2 that we're in? We'll drive 15 minutes across the border to Coeur d'Alene, Idaho, and it's like the world's a completely different world. But then you come back into Spokane having potentially contracted the virus. So I think anytime you're trying to deal with a crisis, whether it's a military response, whether it's a medical response, whether it's an economic response, coordinated responses are always the strongest way to address that. We saw the coordinated response from Congress and the Fed. They acted together in unison, and they acted very quickly. I think we would have been in a better position. Bear with me just a second here. Can you comment on the energy and extraction industries? I'm not an energy expert. The general comment that I'd make there is that is one of the industries that is going to go through an evolution as to where we stood. The U.S. benefited when we had those low oil prices. I think that allowed a lot of frackers especially to open up that maybe shouldn't have opened up. And I think that we're going to level out to wherever the neutral equilibrium is that we probably had too many at the time when we had the low oil prices. We've wiped out quite a few of those. But I think the healthy and the strong ones will continue to survive and thrive. We're continuing to see amazing technological investments with that whole sector, especially the extraction side. I'm talking to one of the oil companies that we invest in from the stock market side. And they're talking about how previously with fracking, it was one line down and then using the sand and everything to extract the oil. Now it's like an octopus where they can have multiple places from that one site. So that continues to drive their break-even costs down. And I think that's why they will still be a force, but it's just going to be a corrective process before we finish with that. What are my thoughts on the SBA PPA loan program? Seems that SBA has continued to make up the rules for forgiveness. Okay, I'm going to admit bias because I work for a bank, but I would tell you the SBA was never a government agency designed to handle that type of a quick, rapid response. And I'm not necessarily going to blame the SBA fully because they were just totally overwhelmed. But you're absolutely right. It has been so frustrating when I talk to our lending side of the thing, saying, you have one set of rules, you work with your client, get all the stuff done, and then they change the rules on you in the middle of the game. That is just the most ineffective, inefficient way to do things. It's consuming a ton of time for both businesses and banks that could be productive time, but it's the reality of a government agency that was just never designed to handle that type of a crisis response. So the concept of paycheck protection, I think, was an excellent concept. Execution, I would give it a failing grade. You mentioned the 2 years before we are back to 2019 levels. Do you anticipate service, leisure, and hospitality getting back to normal levels within 2 years? So I think what I give you, because there's quite a bit to this question, I think, again, leisure and hospitality is going to take longer unless there really is a change. I think the game changer for leisure and hospitality, an effective vaccine, one that instills confidence to the consumer that they actually go out and get the vaccine, and then they feel more comfortable to go out in public that way. Because what we know right now is, I have argued with I've told my board, I think the state could fully lift our restrictions, but maintain the medical mandates, and it probably wouldn't change a whole lot because people just aren't confident. They see so many people not wearing masks. So I'm not writing off leisure and hospitality, said that they are just be thrown to the curb and it'll take forever to recover. They are really going to be dependent on the confidence of the consumer and a vaccine. I think that what we're seeing, other areas that pick up that slack potentially, you see it, especially on the medical side, we are going to be probably needing, because I don't believe this is the last pandemic we're going to have to deal with. I think you're going to see the whole career or field of contact tracing, testing, all of that needs to be ramped up more so that the U.S. has a far more effective response, especially when you look at our response versus Asia, like Japan and South Korea. They've lived through these viruses multiple times: swine flu, Hong Kong flu, bird flu. They're all the same, strain of the coronavirus. So they've been through that drill. They had their systems in place, and they responded far more effectively. So I do think medical will be an area. I think financial services and professional and business services, because you can provide those services remotely as well as in person. And I do think that the goods producing side, especially if we're going to see this shift of people wanting to live somewhere different, and even businesses as they shift to saying, we're not going to be building downtown anymore because the demand is now out in the suburbs, so we're going to put our offices out in the suburbs. I think that you will continue to see, from a demographic standpoint, strong demand for the construction industry, just basic supply and demand. And if we truly want to bring back our manufacturing to the U.S., there's another area that has the potential to benefit. Do I anticipate another stimulus package post-election? So I do think that we will get a stimulus package, but I can't guarantee you. It really comes down to, do we have a split Congress or not? I don't know that I can guarantee that it'll be by the end of the year. I think that it may wait until we get to having Congress sworn in, which I believe is January 10th, and then have the Democrats in place that they have for their new positions. But I absolutely do think both the Republicans and the Democrats understand they need to provide more support. What's going to be different, I think one of the problems with the Democratic package, when they're at $2.2 trillion, they way overestimated the help that state and local governments needed. They originally thought $400 to $500 million. Turns out tax revenues have been a lot higher, especially with retail sales, those types of things, construction-related taxes. So I think that the real number that we've seen from our DC analysts is probably in the 125 to 150 billion level. So if you peel off 300 billion, especially from where they were before, then they're pretty close to where the administration's number of 1.8 trillion is. So I think that's going to be the case. Is the biggest change. There needs to be an adjustment to the state and local side. I would personally argue, but who listens to me, I think that they also need to change, and it needs to be targeted stimulus. It shouldn't be like the $1,200 paycheck, because not everybody, even though their income was below, needed that money. I think it needs to be targeted to small business, because small business, true Main Street America small business, did not get any income replacement like the consumer themselves did. Big business, publicly traded companies could borrow in the investment markets, capital markets. Small business, all they got was paycheck protection, and most of that had to go to payrolls or else your mortgage payments and utilities. I would say if Congress is going to do this effectively, you would target to replace the income for small business while they're still locked down, similar to the consumer. What's the number that really replaces the income and doesn't give them extra income like the $600 a week does? But I do think we will get another stimulus package. I mentioned small businesses that are not back to pre-COVID levels. You also focus on the still closed service sector. Concluding small businesses comprises a significantly higher proportion of the service sector than construction and goods sector. Is that an accurate conclusion? It's an accurate conclusion because the service sector itself is so much bigger than the goods producing side for the economy itself. I mean, we're still, I haven't seen the recent numbers, but I think it's like a 2/3, 1/3 mix there. So very clearly, I think that small business is being impacted, and most restaurants, other than the chains, are small businesses. They're your local neighborhood restaurant, and even some of the hotels aren't necessarily national chains. So I do think that it is the case there because we shut down that sector. It was in the service sector. They've been disproportionately impacted compared to a small construction company or something like that, who may still, once they adapted to the rules, still be able to do their business and not have to be locked down because they couldn't meet the governor's requirements there. Let me go ahead and move to the last part for things to consider, and then I'll take the rest of the questions. I see that we have about 3 more, it looks like, and I will definitely not forget you. I just want to give you my last closing thoughts because they may answer some of those questions, and then my conclusions. What I would tell you is what we need to be thinking about is out of crisis always comes opportunity. One of the things that I said during the boom times, or at least during the economic expansion for 10 years, for those of you who listened to me during those times, I was always telling you that hope is not a strategy, it's an emotion. I'm going to tell you now, fear is not a strategy, it's an emotion. So those who get consumed by fear and are kind of frozen in what they're going to do, they're going to miss the opportunities that come along, because when it always seems the worst is when you discovered there were some great opportunities if you would have kept your head up, focused on your business, not get consumed by social media or 24/7 news, and look for those opportunities. I think especially as I talk about the construction industry, I am clearly not in the camp of the doom and gloomers of saying that we're going to have ghost towns of downtowns. There's clearly going to be some major reconfigurations going on. But I, for one, just from our own experience with the team that I have, because there's only 2 of us working in the office, there's 13 working from home who all swear up and down they love working from home. I just kind of look at that, and I'm clearly not a behavioral psychologist, but I look and say, okay, out of that 13, it's like 10 of them are extroverts. And I just struggle to believe how an extrovert is going to be happy being isolated at home for an extended period of time. I think ultimately we discover that people want to come back to work because it was great for a while, but now I need that interaction. And I think just as much businesses are going to say, you know what, we now have documented evidence as time has gone along that we've lost productivity because we don't have the chance for that instant collaboration of people being in an office, being able to just gather quickly, throw ideas out, and brainstorm. So I don't think, again, I think that we may be reconfiguring how offices look. One of the discussions we were having just within the bank was saying that it may be the case that we discover that many companies don't actually reduce the square footage that they need because they have to have bigger spacing between their employees now. So you may have less employees in the office, but they need more space. So it doesn't actually reduce the amount of square footage nearly as badly as people are thinking. But there's a true challenge there. The real challenge that I would say that the industry faces as a whole, not just the construction industry, business as a whole, is the reality that their expenses are going up related to safety, that type of thing, and yet their revenue hasn't. And so they're going to have to figure out how they work lean and mean to be able to be profitable until we get a virus or something else like that. May mean a lot of work for construction companies with TI work because businesses want to reconfigure their workspaces. But we're also seeing examples of creative thinking, not necessarily on the office space yet. I've read a couple articles that are talking about converting potentially some malls into luxury condo space with all kind of amenities in the middle that way. There's an example of one of our employees in Southern Idaho, whose mom is a high school principal in Idaho Falls. They were looking at building a new high school for the growth they've had, and instead they've leased space for a corner space in a mall that used to be an anchor tenant because they'd have plenty of parking, they could reconfigure it, and be able to work efficiently that way. So my basic message for all the doom and gloom that's out there regarding construction and other things, I would say businesses in general are entrepreneurs. They will figure it out. What you see for an entrepreneur especially is they may have to close their business, but then they will just come up with a new, better way to do things and reopen again. So I do think retail office is going to be the big challenge. The move to online creates a different thing, though. From a construction side, there's going to be more demand for distribution centers. So you'll be looking at that opportunity there. I think that similarly for the residential side, all this movement migration is saying I don't have to live in the expensive cities anymore. There is going to be a fundamental supply and demand driving force there with residential, that what we're going to see, if I'm giving a general characteristic, and it's this oversimplification, my view on the commercial side, especially when it comes to office space, things like that, the big deciding factor now is going to be what's your ventilation, what's your filtration system, how fast can you recycle the air so that I feel that I'm safe and my employees are safe, and what's the solution to elevators? Because who wants to wait in line if they're telling you can only have 4 people in an elevator at a time? We've got to resolve that situation. For the residential side and in the multifamily side, rather than location, now it's internet. I got to have high-speed internet so I can work. And, oh, by the way, I might need either a second room in my apartment or I need a separate room in the house so that I can have a quiet office space to work in. I think that warehouse space, very clearly, there's going to be opportunities there because we're seeing, one, these distribution centers, but the other is a lot of companies decided that just-in-time inventory was too close cutting, that when you lose a supply chain, suddenly you got a big problem. So we've heard talk of businesses saying, I'm going to hold 3 to 6 months supply at home. The rest I'll continue to offshore to find the best efficiency there. Well, that implies you need somewhere to store that inventory. And I would simply say cities that have the land space for it and have a city government that are supportive of business to allow that type of development could see some great growth opportunities there. Similar with manufacturing, that we could see if we truly as a country decide we're willing to pay higher prices by having locally produced stuff, that would produce demand for manufacturing. I think that's on the bottom of my list of opportunities overall. The other one that I've seen, and I just use my mom as the example of with the aging of the baby boomers, the phenomenon we're seeing from the baby boomers is they're willing to downsize, but they're not willing to give up all their stuff. So rather than getting rid of the stuff and saying, I don't need this anymore because I'm moving to a smaller place, they put it in storage. And they leave it as a problem for the kids that once they pass away, now you can sell that stuff, but you can't sell it while I'm still alive. So I think there are going to be opportunities throughout the construction industry that way, that we will still see different things popping up. It's really kind of come down to, once again, my basic viewpoint is that you need to keep your head up, not down, buried in the sand, just hoping things will get better, and be looking for where the distressed areas are, where the new demand is forming, and can you respond quickly enough to say, I can respond to that type of marketplace and be a player in that marketplace. But I'm far more of a long-term optimist, even though I very readily admit there is a lot of turmoil and change that's going to happen in between. And we're going to lose potentially a lot of businesses, but new businesses forming as a result. So I think that's really what I would tell you is just keep in mind, again, use as Warren Buffett had said before, the best time to be investing in something is when everybody else is running away from it. And the worst time to be investing in anything, whether it's a building or investments, is when everybody's piling into it. So this may well be the case as your opportunity, people running away from certain parts of the construction industry, that you may discover there's opportunities that you can use automation, robotics, other things to make that an efficient way to build those things with the new structure and new demand that needs to be done to deal with the virus situation. Because I truly do believe, even though we'll have the vaccine out, I think the U.S. may discover we're going to be similar to Asia now, that we see more of those coming up. So my conclusion, and then I'll try and answer the last of these questions, I just simply say we as a country need to figure out how to be rational, objective, and have conversations, because we need to find the balance between what's the right level of lockdown versus being open. Because what I will say over and over again is that we need to find the balance between saving lives lost or deaths from the virus itself versus deaths of small businesses and deaths related to mental health because of the isolation situation. I think that as an economist, my viewpoint is phase 2 is too restrictive. We've done this for 6 months, and we've done this actually for 8 months now. I think that everybody who's going to wear a mask has got that habit established, even if you fully lifted the restrictions, and those who don't wear masks are never going to wear masks. But we need to at least start having those conversations to say, what's the trade-off? What's the right balance so that we can move forward with getting the economy open? So let me try and push through now. I know I've got about 4 minutes, but see if I can answer. And again, any questions I don't get answered, because I want to honor your time, please, Elaine, shoot the questions to me, and I'd happy to respond back and give the answers to them. One of the questions with trillions of dollars the federal government has spent in helping keep the economy crashing, what measures are they going to have to take to recover that money? The simple answer I'm going to give you there, somebody's got to pay for that. It's just like if you're out there spending like crazy with your credit card, eventually the bill comes due. So I'm going to tell you, unless they look for something like infrastructure spending that actually is a productive investment where you get a return on that investment because business builds around it, it's going to come down to the taxpayer, the working taxpayer. And unfortunately, I think the reality is the bias, whether fair or not, there still is this unfounded belief that business hasn't paid their fair share of taxes. So I would expect somewhere down the road, not immediately, we're going to be dealing with tax increases, because that's the way we're going to have to deal with paying off the debt that we've created there. What do you see?
So, Steve, can we do the last polling question quickly? I didn't mean to interrupt.
I'm sorry, yes. And I do want to see
Thank
that.
you.
So if I can have the last polling question, because I really do want to see your feedback from that. What do you think the delinquency rate for commercial office space will be 6 months from now? You guys are more the expert on that than I am. I've read various articles, but I'm certainly not the one who's got my finger on the pulse of what's going on there. And while we're waiting for those responses, let me try and jump through a couple questions. Where do I see home prices going? Stabilizing or continuing to rise? I think home prices could stabilize or actually fall in the areas around big metropolitan cities if employees continue to say, I can actually go live anywhere I want. The bad news is for places like Boise, Idaho, or Spokane, Washington, that means there's heavy demand, not enough home supply. I think that creates home prices going up. But even for the Puget Sound region, for Portland and other places, you still have a fundamental supply problem. So if I'm telling you home prices, I think that they will rise until they fundamentally reach a point where people say, I can't afford that anymore. And then you'll see it stabilize and start to drop off because people will look for somewhere else to live. But I don't see anything that's telling me that this is going to be a housing bubble, because it's not speculation, it's fundamental supply and demand. So most of you are saying 15 to 25%. The next group says 1 to 15%, with 28% of that. And then 19% of you say over 25%. So there's your potential challenges to watch for as to what develops with those vacancy rates. Let me scroll through here. Where do you foresee office space leasing headed with more people heading home? I think I talked about that to a degree, is that as leases come due over the next year or two, there's clearly going to be pressure on lower rates because of the adjustment that still has to happen. But I still think that there's going to be a role for office space, and I'm not going to be the one who says that we have to have a huge plummet in lease rates before you start to see office space stabilize. And, oops. I'm trying to, home prices, I think, Elaine, have I missed any? I miss on the numbering, but I don't see, I think we've got the two that I see showing up. Do you see any others that I'm missing for questions?
No, I think you've got them all. Thank you.
So to wrap it up for you, like I said, I am maybe at my core, I'm an optimist, but I'm also a realist. So I am going to make no case to you to say, don't worry, be happy. I think there's some real challenges, especially for the dense metropolitan areas, because we have to reestablish consumer confidence that it's safe to be out there. And that's why I say we've got to have these objective discussions about where's the balance, and we've got to move forward on getting our economies reopened while still dealing with the medical situation there. So I would just tell all of you, the best advice I can give is the one that our chairman gave to all of our company back about 4 months ago, where he said, my best advice to you, especially if you're working from home, is to go on an information diet. And what he meant by that was, you didn't watch the TV when you're in the office, turn off your TV while you're at home working, and you'll be amazed how much your stress level will fall. And he really emphasized, spend time with your family, focus on your job so you're doing the best you can, focus on your clients and meeting their needs. And if you do that, and we all do that, we're going to look over our shoulders 9 months from now or 6 months from now and realize that we've progressed quite a ways compared to if we get sucked into the media trap. This could be a much slower recovery because people lose their productivity. So I want to thank everybody for attending. I'm going to kick it back over to Elaine, but it's always a pleasure to talk with the group. But I got to say, I have my fingers crossed, my Lucky Charms and everything else out so that by next November, I'm hoping if I have the opportunity to present at this conference again, it'll be in person and not virtual. Elaine, I'll kick it back to you.
Thank you so much, Steve. Once again, this has been so informative. We really appreciate your time, and I can guarantee you that you will be invited back again next year. And I am also hoping that we can have some in-person sessions as well. So, but thank you. I hope everyone enjoyed today's session. If you do have any further questions, don't hesitate to let us know, and we'll be sure to pass them on to Steve. Have a great day.
Thank you.
Thank you, everyone, for attending this morning's session from the Building Opportunity Conference, Post-Election Economic Considerations. For more information on the conference and our upcoming sessions, please visit the resources widget here on On24 or visit bossadams.com. Momentarily, a webcast survey will be launching in your browser. Please feel free to give us your feedback on the session today. And as Elaine mentioned, we look forward to seeing you at another event in the near future. Thank you, everyone. Have a great day.